Imagine earning 15% APY on Bitcoin with zero exposure to its price. Bitcoin pumps, you make money. Bitcoin crashes, you still make money. This isn't a scam. It's called funding rate arbitrage, and professional crypto firms have been printing money with it for years. By the end of this video, you'll know exactly how it works and how to do it yourself. Here's the thing about crypto. You want yield, but you also don't want to pray every morning that Bitcoin doesn't dump 20%. You want exposure to the asset class, but not to the volatility. Most so-called safe yields in DeFi still leave you exposed to the underlying token's price. Funding rate arbitrage solves this. It's market neutral, delta zero, pure spread capture. Let me explain. On every major crypto exchange, Binance, Bybit, Hyperliquid, you can trade something called Perpetual futures, Perps. They track the spot price of Bitcoin, but they have no expiration date. To keep the Perp price anchored to the real spot price, exchanges charge a thing called the funding rate. When more people are long than short, longs pay shorts. When more people are short than long, shorts pay longs. The payment happens every 8 hours on most exchanges, every 1 hour on Hyperliquid. In bull markets, longs aggressively pay shorts, sometimes 0.05 to 0.1% every 8 hours. Annualized, that's between 50 and 100%. Here's the trick. You buy 1 Bitcoin on the spot market. At the same time, you short 1 Bitcoin worth of perps on the same exchange. Your net exposure to Bitcoin's price? 0. If Bitcoin pumps, your spot goes up by exactly what your short loses. If Bitcoin dumps, vice versa. But the funding payments? You collect them every 8 hours, forever. Let me show you real numbers. Say you have $20,000 in capital. You buy $10,000 of Bitcoin on Binance Spot. You short $10,000 of Bitcoin perpetuals on Binance Futures, using 1 times leverage so you don't get liquidated. The current funding rate is 0.01% per 8 hours, a typical neutral market. That works out to 0.03% per day, or roughly 11% annualized. On $10,000 of short exposure, you collect about $30 every 10 days. That's $1,100 per year on $20,000 capital, fully delta neutral. In hot markets, when Bitcoin is making new all-time highs, funding rates explode to 0.05 or 0.1% per 8 hours. That's 50 to 100% APY for a few weeks. Risk-free in terms of price direction. Professional firms running this strategy averaged 19.26% returns in 2025, beating most hedge funds, with less risk. Here's how to do it yourself. Step 1. Open accounts on a centralized exchange that has both spot and perp markets. Binance, Bybit, or Hyperliquid all work. Hyperliquid pays funding hourly, which is faster. Step 2. Deposit USDT or USDC. Split it 50-50 between spot wallet and futures wallet. Step 3. Use the spot wallet to buy Bitcoin. Use the futures wallet to short the same dollar amount of Bitcoin perpetual at 1 times leverage. Always 1 times, never higher. Step 4. Every 8 hours, the exchange auto-pays you funding. Set a calendar reminder to check rates weekly. Step 5. When funding rates flip negative, meaning shorts now pay longs, close both positions or flip the strategy. Bots can do this automatically. The risks are real. Exchange risk. If Binance goes the way of FTX, your money is gone. Use multiple exchanges. Funding rate flips. Neutral or negative funding zeroes out your yield. Watch the rates. And finally, capital efficiency. You need real capital. $500 won't cover the fees. If you want to see how to automate this with a bot, drop a comment. Subscribe to the Yield Lab. Every week we decode one yield strategy that actually works. See you in the next one.